Okay, so welcome to this panel on the Basel journey. My name is Cameron Stanton and I work within the Trade and Working Capital team within Lloyds Bank. Today I'm delighted to be joined in the room by Pablo Ballesteros from Santander and Robert Wendt from MUFG. And digitally, we're also delighted to have Scott Stevenson joining from BAFT as well. We do a bit later on as well also have a short video from Andrew Wilson at the ICC, which we can also share. The Basel reforms is a very broad and technical topic. Luckily today we are just focusing on the implementation and the divergence that we're seeing globally, as well as engagement with the regulators and getting our clients engaged as well. I'm sure everyone will be devastated here. We don't have enough time to go through the full nitty-gritty of everything Basel, but there is a number of resources that BAFT and the ICC have prepared, which should be showing on the slide behind me, if possible. No? Okay. If not. Yep, there we go. Grand, thank you. So there are a number of resources here which can be accessed, which go into the great depth of the number of changes we're going to see in the area. But I would digest that in your own time because there's plenty to go through. So without further ado, I think we'll just kick off with the panel. So Scott, just to get us started, Basel 3.1, Basel 4, Basel Endgame, are we all talking about the same thing here?
Yeah, basically what's going on a global basis. I won't go into too much about what's going on in the United Kingdom because Chris will cover that off. But basically, as a result of the 2008 financial crisis, the Basel Committee, as we're well aware, decided that they needed to take a look at how they could best de-risk the financial system. And so they came up with a series of guidelines that were intended to take leverage out of the international banking system and create a safer environment. When they decided to do that, they kind of treated all and any products on the same basis. And so
I think we lost him.
Okay. Some technical issues. Okay, no worries. Just while we're waiting for Scott to rejoin, Pablo, are you able to shed some light in terms of what's happening in Europe and where we're diverging, as well as Santander's? Obviously, you've got presence across South America, North America, and the UK as well, and there are different approaches you're taking.
Perfect. So let me start by saying that the EU Basel III process has been a fascinating journey, and that may sound a little bit strange, right? Financial regulation is not always the most appealing topic. It's not what you discuss with your friends when you go for a beer. I do that from time to time because I'm a little bit weirdo, but it's not the most common thing. But I'm saying that it's been a fascinating topic, not because it's crucial for our activity, which it definitely is, but because it has been a great collaborative effort across the industry, putting together banks, corporates, and obviously industry associations as BAFT and ICC in a common effort. So that's why I feel very, very pleased and very happy to be here and be able to share a few headlines, right, with the audience, where I recognize many people that has contributed a lot to the process, as our colleagues from Crédit Agricole or ING, just to name a few. So having said that, let me start by setting up the background, right, for those of you who are a bit less familiar with the topic. The European Union is about to finalize the Basel III implementation, a process that has taken over 2 years. As of today, the 3 European legislative bodies have agreed on the final version. This is the European Parliament, the Council, and the European Commission. They have all agreed in what's going to be the regulation. This is in the path of being validated by the legal team and the translators, and it will be formally approved in the Parliament during March or May, and will enter into force 1st of January 2025. Okay, so those are the key dates. During this 2-year process, as an industry, right, we have been able to really change important things for trade finance. And just to name a few, the most important one is the treatment for technical guarantees, right, for performance bonds, where we were able to keep 20% for trade finance performance bonds. Also, we had a threat, right, of this being increased to 50%, which will have been a very important impact for our corporate customers. Unfortunately, on the last minute, there was a last change in the wording that may create some confusion in the future, but that's something we will tackle later on. The second very important point is to be able to recognize the effective maturity for our products, something that was not clear, right? And now it has been clarified that the short-term nature of trade finance has been recognized. And the last point is also that for uncommitted lines, there was a threat to have a small capital surcharge, but that has been also heavily mitigated, as it will only kick on in 2029, and there are some exceptions that trade finance will be able to fulfill. So a very important achievement for the trade finance industry in this regard.
And Robert, we've just heard what the situation's like in Europe. From MUFG's perspective, obviously globally active, but Japanese focused originally.
You see me sitting here green with envy. Yeah. Listening to what Pablo was saying, so Japan in its implementation is very much the keeper of the true faith. We are alive since the 1st of January this year. So the output floor is coming in for us as an IRB bank. It will be officially fully loaded by 2029. However, there's an important detail in Japan in that the way of the samurai is a lot more long-term. So a few of us that are old enough will remember there was a transitional output floor when we migrated away from Basel I to Basel II at 80%. That output floor was never abandoned in Japan, with the effect that effectively Japanese banks are already fully loaded on the full output floor. Has the advantage that there's not much capital raising to be done, but obviously quite significant implications for how we do our business, and particularly around the trade finance piece. So for us, we now officially have a restriction on the 20% credit conversion factor, which now only applies to import-export LCs with maturities of less than a year. Everything else moves up to 50% or even 100% credit conversion factor. It has implications, obviously, that we need to address around the organization, but we had a good deal of time to prepare for this. So I think we're positioned well to deal with them.
And I know from a UK perspective at the moment, it's still key if the PRA is planning to diverge from the EU on key parts like the 20% CCF treatment for guarantees. So I know that the UK banks, in partnership with the ICC, similar to what you've just discussed, have done a lot of engagement with the PRA, but also Treasury, and more recently with the Department for Business of Trade, where we're seeing a lot more traction, primarily because a number of the changes which are currently being proposed will go in complete opposition to what is being said from a government perspective on their need for trade and exports.
And maybe let me just speak out a bit on the divergence topic, right? Because also from Santander we suffer that as we are a Spanish bank, European bank, but also a bank in the UK, Latin America, US, and so on, right? So obviously for us as an organization it's a complex process because you need to deal with different regulations, right? So at some point you have a transaction locally that may be profitable, but it may not be profitable at that consolidated level, and that creates some issues in terms of reporting, admission processes, and so on. But what I think that it's really important is that trade finance is a global business, right? So it's not so much about if, I don't know, maybe European banks, they get to have some advantage when it comes to technical guarantees, because when they want to do business in Australia, in the UK, or in the US, they are going to still bear that problem, right, of having different frameworks and different pricing, right? So I do think that as a global industry, we need to try to keep on pushing for global harmonization.
Yeah, definitely. And I'm unsure if we have Scott back yet. No? Nope.
I think so.
Nope. Do we have him? Okay. Oh, so we do. Sorry. So, Scott, we've just touched on the piece from the UK, the EU, and Japan as well. But I understand you've done a lot of work with BAFT and finalising the sort of end game sort of proposals, well, the report from BAFT on the latest proposals in the US. So I was just wondering if you would be able to comment on the main areas that you've pulled out there and where it differs perhaps from some of the other issues we're facing into. Okay. Cool. Cool. While we troubleshoot, it may be at this time, it might be worthwhile if we can play the video from the ICC, just while we're... Wonderful. Oh.
And if we can hear it, it will be perfect.
Okay.
Good afternoon. I'm Andrew Wilson from the International Chamber of Commerce. My apologies that I can't be with you in person in Frankfurt today, but huge thanks to our colleagues from BAFT for this opportunity to speak with you virtually on an issue which is of paramount importance to us institutionally and indeed across our global network. Let me start by saying that as ICC, we are very much alert to the downside risk that future changes in macroprudential regulation could adversely impact the supply of trade finance to the real economy. We take that risk very, very seriously, and that's why we believe it's absolutely essential that industry is and continues to be alert to potential regulatory changes, but also prepared to engage in a way that enables evidence-based and effective regulatory outcomes. In that spirit, I wanted to share with you very quickly two learnings, two observations from our recent engagement with the European Union on the revision of the Capital Requirements Directive. The first is the importance of being able to engage corporates to actually dispel the notion that advocacy on trade finance is self-serving propaganda from the financial services industry, but that changes in Basel implementation can have serious unintended consequences on the competitiveness of local industries, indeed large and small businesses alike. I think we deployed the corporate voice very effectively in Brussels, and I think it's something we need to do more of in other jurisdictions as and where necessary. But secondly, the more important point is on the availability of data. I think the data we were able to deploy in the context of the CRR revision was absolutely pivotal in securing changes to the treatment of technical guarantees, for example. And I think the challenge we face today is the ICC trade register simply doesn't have sufficient coverage to allow it to be effective globally. We need more banks, we need more regional coverage, and we need ultimately more data. So really my challenge to all of you is to consider how you can work with us. If your bank today is not a member of the ICC trade register, we'd encourage you very much to give some thought to how you can contribute to that important initiative going forward and allow us as an industry working with institutions such as BAFT to be able to put evidence firmly on the table to make the case for revised treatment of trade assets and to do so in a way that allows trade finance to feed and nourish the global economy. I hope that's helpful for the discussion ahead. Many thanks, and I hope to see many of you soon. Bye-bye.
Okay, thanks.
Great. Glad to have you back, Scott. We'll touch on the video there from Andrew in a second, but just now that you're here, You've just finished putting the finishing touches on the BAFT and industry response to the Basel Endgame proposals in the US. Can you give us a flavour of how the US are approaching the changes, and what are the main areas you've called out, and are they differed from what's been discussed so far?
Okay, yeah, thanks. I do apologize. I had some, we're having inclement weather here as well, and there was the always what was known as Murphy's Law, where if anything could go wrong, it would at the worst time. But now there's Cohen's Law, and Cohen said Murphy was an optimist, and that's what happened to me here. Yeah, so basically what's happened in terms of the U.S. regulators is that they have, in effect, gold-plated what the Basel Committee first put forward. And there's a couple of areas that diverge from what we've seen from in the UK as well as the EU. What's essential to know here is that unlike the EU and the UK, in the United States, the implementation of Basel III, or what they call here the Basel Endgame, does not need legislative approval. So whereas in the EU and the UK, you've got the ability to lobby with your legislators, with either the European Parliament or UK Parliament, in order to kind of represent what industry feels is a fair application. In the United States, the Fed, the OCC, which is the Office of the Controller of the Currency, and the FDIC, the three U.S. agencies that are involved in this Basel Endgame, they are the final arbiter. And so we really have to put forward our best shot and then ask that we be able to meet with the technical committees of the Fed to be able to sit down with them and go through where we feel is an unfair, probably uneven application. In terms of the U.S., there's a couple of areas that diverge from what we're seeing in the EU and the UK. The first is in the area of defaulted exposures, and this is really quite problematic because what the Basel Endgame is putting forward is that any obligation, whether it is to your bank or another bank that your corporate client has, that goes 90 days past due is considered a cross default and should be treated as such. This is a really kind of a draconian approach and be particularly problematic in terms of supply chain finance. Because, you know, the time that it takes to settle thousands of trades in terms of supply chain, if even a small exposure doesn't settle within the 90 days, that technically under the new Basel guideline is a cross default. And you can understand how difficult this would be. The other thing is that, as we all well know, many times in trade there are legal disputes which eventually get settled. But under this new guideline, if the legal dispute goes past 90 days and there's no payment, that also constitutes a cross default. So we've really pushed back against that. Another thing is the risk weights in terms of bank exposure have increased, the 20% guideline that was pretty well used across the board is now being increased to 40% and 100% in some instances. Tenor for instruments in the UK. There's a 6-month floor, whereas the NPR, which is the request for proposal from the U.S. regulators, has gone to a 3-month ceiling. So that again puts it's a competitive disadvantage for not only the banks but more importantly for their clients. The U.S. right now has a 50% credit conversion factor for performance guarantees. In the EU application, successful lobbying brought that down to 20%. So if the U.S. stays at 50, which was really in the original Basel guideline, that again will put the U.S. at a competitive disadvantage. The last thing that I wanted to talk about in terms of major difference is in the area of operational risk. And this is really quite problematic because for the first time, the Basel Endgame is putting forward a proposal whereby fees generated by trade services, or any services really, but specifically we're looking at trade services, would be subject to a capital conversion factor. This really is problematic in the fact that, as we well know, take your basic letter of credit. Attached to that, you would have advising fees, negotiation fees, cancellation fees. Well, underneath this new Basel regulation, those would all be subject to a capital charge as well. So there in effect would be a double whammy against trade products. And so our pushback is that this is, first of all, it's not being applied in any other jurisdiction. But secondly, it doesn't make sense because the banks already, in their operating risk portfolio, apply risk for operational risk. And so to apply capital risk on top of that is again, a double effect. So what we're pushing for is the fact that, yes, banks will have to pay more. We understand that. But at the end of the day, it's really the corporate client that's going to be the person who is penalized the most in terms of the application, particularly SMEs. And our point is that trade finance is working capital. And it's a form of working capital, and it's reasonably priced. There is no leverage in trade finance. And so that if you now are going to be increasing the cost of these products, you could well be pushing some clients, particularly the smaller scale, the SMEs, mid-market customers, into a gray market, which then take them out of the regulatory framework that these regulators are so keen to enhance. So we've made our application. Our letter to the Fed will be available on the BAFT website, so we'll circulate that, and we're kind of keeping our fingers crossed that we have the ability to meet with the regulators and walk through our points of contention.
Great, thank you very much. Robert, so we've heard a lot about massive changes over huge client impacts. Are clients aware of this impact to them, particularly, I guess, on that SME front? And what more can be done to raise that client awareness?
Yeah, maybe 2 points on that because I think before you approach the client, you need to understand how your own internal pricing model and return model actually recalibrates with these changes. If your return model internally, and I'm a portfolio manager, I'm not in trade finance, if your return model very rigidly sits on RWA, you will see massive effects. So we're not talking about RWAs going up by a benign percentage. We're talking about multipliers in some cases, 3, 4, 5 times the capital. Accounts that looked fantastic turn into dogs overnight, basically. You have to prepare the organization for this. You have to engage the people that are building these pricing models for you internally. You need to review your business plans, how that all fits in, your business strategies based on that. And not to be underestimated, there's a massive internal communication piece to be done. You need to not only communicate to your product people, you actually need to brief all the coverage people as well. And that takes a lot of time. These might be, in essence, relatively straightforward changes. Truth be told, the communication piece took us the best part of 2 years until we were reasonably certain that across the organization everybody had understood the implication. I think then you can start to think about how to approach the clients on this, and explain it to them. Now we have heard how all the regulations are slightly diverging, and that makes for very uneven communication, particularly if you have clients that are set up in different jurisdictions, like Pablo has mentioned. The same goes for us. Regulation may deviate, so the client may hear from different institutions, even from within the same organization, quite a different narrative, because something might work locally in regulation, but it doesn't work on consolidation, as Pablo has said. That said, it needs to be done. So the best thing is actually to sit down with the client, to communicate to them. In our corporate culture, it is all about longevity and sustainability of the client relationship. So there is a transition, and adjacent to the changes that we're talking about here with Basel, you have everything else coming with net stable funding ratio, liquidity coverage ratios. So the client also needs to understand how your cross-sell mix across all these products might be impacted by this. Now, it's an unfortunate result and maybe an unintended consequence that Basel is hitting the trade finance products so hard, and it's never a good result that regulation in the end drives commercial decisions. But here, there's no beating around the bush. This is exactly what is happening, and clients need to be with you on that journey.
Definitely. And Pablo, where these client impacts are so substantial, you've had some success in terms of the European banks lobbying the European authorities to kind of get changes, particularly on CCF treatment for performance guarantees. Is there scope for more to be done there, or do you think it's essentially signed and sealed at this point?
So I will say that during this advocacy journey, there are 3 lessons, right, that we did as an industry that were successful, and we will need to continue doing them in the future. The first one was to act very quickly and take action. No? So as an industry, the moment the proposal for the regulation came out, the working groups of BAFT and ACC were formed, and we quickly agreed in which was the position to start advocating. But also I think that it's important for the future that you just not prepare the position paper, you need to go and talk to the regulators, right? They are very busy, they receive hundreds of papers. If you don't go and sit with them and explain the proposal, they are not going to pay attention to you. The second point that was very important is that you need to be strategic about the points you want to raise, right? Also the policymakers, they are not super technical, they are not aware of the nitty-gritty detail of the things. And obviously in the new capital requirements regulations, there are many things to be improved, but we just select those ones that have a massive impact on the real economy and that as such are easy to be understood from their point of view. And the third point that I think is super important, and it touches also on your point on corporates and the points that Andrew mentioned before, is that when we went advocating, we were not the banks alone, right? We were there with the data and we were there with the corporate clients. And that was super important, and just let me give you two examples, right? The first one is when we sit down with the German Ministry of Finance, as diligent as they are, they were the only ones to ask us, okay, you defend at 20% for the technical guarantees, but show me the data, right? Show me that that's true. And we went with the ACC trade default register to show that during 20 years across the crisis, the good cycles and so on, default rates and claim rates were really, really small. So we were able to clear their problem, and we need to continue building on that data to have a proper advocacy. And the last point was to have the corporates, right? I also remember when we went talking to the European parliamentarians, and first, the script was a little bit for the banks to start explaining the issue, and you can see in their faces, they were like, oh my God, here there comes the bank again to complain about the profitability and so on. But when the corporates kick in, right, and you really see, for example, a European wind turbine manufacturer that was explaining how performance bonds are critical to develop clean energy projects in Europe, how if the cost of performance bonds increases, the cost of the projects will increase, and in the end, the energy prices will be higher for the taxpayer. Now they start paying attention, right? So I think involving the corporates is something we need to do during the advocacy process, and it will help us to be more proactive and deliver the message to the regulators.
Definitely. And Scott, you've been actively engaged on this topic globally with the banking industry as well as policymakers and regulators. Do you think there is that awareness of the inconsistencies and the understanding of what potential impact this will have? And to Pablo's point, how can we better use corporate advocacy to kind of drive the changes and get a bit more consistency here?
Well, I think the use of the corporate advocate is absolutely essential. because at the end of the day, if you look, the regulators, there's no upside for a regulator. And if they have regulations that are too lax, they're penalized for it. And so they're going to come in with the strongest framework that they think is necessary. What was interesting in the United States is that for the first time, there are 6 governors who sit on the Federal Reserve Board. And when the presentation for the Basel Endgame was made to these governors, 2 of them actually voted against implementation, which is almost unheard of. And the points that they raised, which is essential, is 1, what are you going to achieve with these with the new regulations? What is it that's going to be created in terms of a greater safety framework for the banks, particularly those that are already well capitalized? But secondly, what does this do to the United States in terms of its competitive position? I mean, when it was described to the Federal Reserve, the European regulations, if they were brought in, would be pretty well, let's say, a 12 to 13% increase in capital for the biggest banks, capital needs. For the UK, it was somewhere around 14%. And for the United States, it looked like it'd be somewhere between 19 and 20% increase in capital across the board, and if the new Basel Endgame was brought in. And so the whole issue, one of the major concerns, of course, is regulatory arbitrage. That's been raised here in the panel. And if you have a corporate in the United States trying to compete against a corporate in Europe, and they have difference in pricing, then you're going to make your own national industry less competitive. So, so at the end of the day, all politics are local, and it's the banks are always kind of seen as the no one really is going to cry if a bank has to lose money or has to pay more. But when it hits a corporate and then the employees of that company are in effect affected by the competitiveness of their own business, then it comes home to the legislators. Even in the U.S., the U.S. Congress has written a number of letters to the Fed saying that you've produced a 1,000-page document with absolutely no data to support your requests for increase in capital. And so, again, it comes down to effective data being able to be presented. The last thing I'm going to say here is that there is little or no understanding of trade finance in the central governing bodies. And we've seen that over and over again, and why it should be treated as a separate class.
Great, thank you very much. I am just conscious of time, so if we can maybe just pick off the couple of questions that we've had in. So the first one, I'm going to come to you for, Pablo, which is the sort of, what is the impact of the last-minute change in the final proposal by the EU that was mentioned at the beginning of the session?
It's a good point, because it's definitely something that we are going to need to tackle as an industry. And the point is that what they have done in Europe, they have differentiated between trade finance performance bonds that has the 20%, and non-trade finance performance bonds that will remain at 50%, right? The issue there is that there is not clear guidance to differentiate the both of them. There is not clear definition of what a non-trade finance performance bond may be. I'm not really sure about that, but that's the topic that I think it could create a bit of uncertainty, and that therefore at an industry level we will probably need to clarify that.
And then just quickly on the last one, on how will the Basel IV regulation impact the treatment of working capital instruments in terms of effective maturity versus the 2.5-year floor? Does anyone want to briefly touch on that? Robert?
I can. I think the bigger impact is actually coming from the output floor, is my feeling. The output floor sits on standardized, so basically you're no longer modeling maturity, you're no longer modeling LGD. Maybe a point on this, which is also quite relevant, because everything sits on external ratings. There's a big assumption that people sometimes make that every subsidiary of a corporate actually is covered by the rating. That's not the case. So if you don't have guarantees in place, that rating doesn't travel, and out of a sudden you're at 100% risk weight.
And also I will add to that in the European Union, one of the capital methodologies that will be used for banks and large corporates has a fixed maturity date of 2.5 years. And that obviously will have a huge impact for trade finance, no? That by nature is very short term. What they have done in Europe at least is that they give the authority to the banks to choose if they want to use the 2.5 years or if they want to move to the effective maturity, right? And therefore you can make the choose to, okay, if I want to provide a fair treatment for trade finance, I will be able to use the effective maturity. I think that's also positive to recognize the short-term nature of the asset.
Definitely. Unfortunately, I do think that is us at time. So technical issues aside, although it is good to see that it's not the only one suffering for weather, just in Frankfurt, I would just like to thank the panel for their contributions today. And the main takeaway, I think, for everyone here is to definitely go away, digest the material that's available, understand what this means for, well, your regions, your bank, and more importantly, your clients, and then understand what you can do and what your corporates can do as well to drive the changes to ensure that this isn't as disastrous as it possibly could be. So that's it from me. Thank you very much.
Thank you very much.